macro market trends, stock selection, ETFs, options, just some of the topics covered in Tactical Trading. Well, now we're going to zero in on the price chart of the S&P 500 and find out what our tactical trader, Kevin Cook, sees for the market over the next couple of months. I ask you to look into your crystal ball here for the next couple of months, Kevin. So, on August the 3rd, you wrote a column titled Look Out Below, or maybe Look Out Below.
Yeah, pretty much.
Explaining why you thought the S&P 500 was headed to 1,200, next stop. And then it went down 5% and closed there precisely the very next day.
Yeah.
Are you always this good, or was that a fluke?
I was lucky. I didn't think it would go there all at once in a 5% move the next day. But the market got really dramatic, and we'll talk about why. We're going to talk about the fundamentals first.
Okay.
Here's the Federal Reserve's GDP forecasts that came out in June. And the Fed was basically looking to hover around 3% growth for the full year. Based on what we thought the first couple of quarters looked like, it seemed like we had to grow at about 3% to get in their range of around 2.7 to 2.9% growth. And the Fed is the most cautious of observers, really. And Brent Bernanke was very cautious in June, and yet these are still very optimistic predictions, all right? Well, July 29th, we got the final GDP revisions for several quarters, and they all went lower.
Right.
Basically summing up that the first half only grew at 0.8%, abysmal growth.
Right.
So we got that on Friday, July 29th, and we come in August 1st on Monday, the market's going to start to process this, right? We're also worried about the debt ceiling, which was August 2nd. But really, that seemed like the front and center story. Really, the underneath story was the GDP. So we'll look at this price chart now of the S&P. Where were we? I was looking at, we traded down that Tuesday and Wednesday, August 2nd and 3rd, down to the 1250 area on the S&P. Very critical to me. Why? Because you go back to March, that was the March lows on the Japanese earthquake and unrest in oil-rich regions, right? So we went down to 1250 then. Then in June, we go down to 1260. So if the market's coming back down to that support area and really threatening it, which it was on August 2nd and August 3rd, we were in trouble. So that's why I said look out below, because this thing's going to go a lot lower.
Yeah.
That was my basic thesis.
So you used then both fundamentals and technical price outlook to predict the decline. What you called on August 5th a very quick pricing in of a probable recession. So what do your indicators tell you now that we're a little bit removed from that?
Yeah, so that article you're talking about on August 5th, I said, how long will the correction last? And I think it'll last a couple of months because, yeah, we priced in the recession quick, but now we're waiting for more data. We need to see, are there going to be earnings warnings in September? And what are the new GDP forecasts going to be? Not only from the Fed, who didn't give us anything new last week. All they did was say, hey, we're going to keep interest rates low for the next 2 years.
Right.
That isn't exactly an optimistic tone if they have to keep interest rates low that long. So we also need to hear from big money managers and economists. What are their GDP forecasts? So we're going to wait for more data. So I think the market trades sideways between 1150 and 1250 for the next 2 months until we get more data. Okay. We've actually been down to 1100.
So tell us why you think 1100 and 1250 are such significant support and resistance points on the S&P 500. And what about this death cross business that you wrote about? Now, I've heard that mentioned a few times.
Yeah, the death cross they call when the 50-day moving average crosses below the 200-day moving average.
Yes.
So we'll look at that and we'll cover both these points, why 1100 is important and why 1250 is important. So first, there's the death cross up there around 1280. 50-day moving average slipping below the 200-day. Very bearish sign to some people. But moving averages track, price trajectory, and they're sort of it is an average, and markets always tend to revert to the mean. So we've run so far away from these moving averages, we're due for a bounce back. So that's why I see this market can trade back up to 1250. But there'll be some resistance there until we have more information.
All right.
Now, why was 1100 such strong support for the S&P? Well, you can see on this chart, I have this yellow ellipse. That's about a year's worth of time from October 09 to October of 2010, where you basically can see the market gravitated around the 1100 level on the S&P. That kind of major price consolidation and congestion means there's a lot of buying interest there. That's a value area that money managers see. And if you take forward earnings for the S&P anywhere near, say, $90 and an S&P price of 1,100, that's a very cheap multiple. That's the S&P on a valuation basis below 12 times earnings. So money managers will see a lot of value down there in the 1,100 area, and of course that's what we bounced off of, that major congestion area. So that's why that if we go below that, that means the probability of recession is much higher than anybody thinks. A lot of guys out there are thinking 40% chance of a recession. If we go below 1,100, the market is pricing in a much greater probability of recession.
I see.
Okay.
So you did write, am I correct in that I read you did write, don't worry about the death cross right now?
Exactly. Because look, it happened back in, it happened last summer.
Yeah.
These things happen, and really the economic fundamentals will dictate our next move. So back last summer when it happened, fundamentals trumped the technicals. Right now it's a concern, but we're actually going to trade back up to 1250, I think, and we're waiting for more economic fundamental data.
Okay. Kevin's tactical trading columns appear regularly on our homepage on Zacks.com. In case you haven't seen them yet, or if you're not viewing this video from the website, Zacks.com, you'll want to go there. And look for the green banner that says Stock Picking Strategies. And right under that green stripe banner, you'll see Kevin's picture appear with the link to his most recent column. Those columns change frequently, so you'll want to check him out frequently. And you can also follow him on Twitter at Kevin B. Cook, right?
Yep. Thanks, Terry.
All right. I'm Terry Ruffalo along with Kevin. We'll see you next time here for Tactical Trading.